From Hamilton Place Strategies in Washington, D.C., this is the HPS Insights podcast.
Welcome to HPS Insights, a podcast from Hamilton Place Strategies analyzing the current events impacting the business and political communities. I'm your host, Jonathan Graffeo, Managing Director at HPS. Today I'm thrilled to host Mark Calabria. Mark was the Director of the Federal Housing Finance Agency from 2019 to 2021. Prior to that, Chief Economist for Vice President Mike Pence. And prior to that, he was the Director of Financial Market Regulation Studies at the Cato Institute. Mark, thank you very much for joining us today.
Really a pleasure to be here.
Mark and I go back even before he was at the Cato Institute. We both served on the Senate Banking Committee under Chairman and top Republican Senator Richard Shelby. That was during the 2008 financial crisis and the Dodd-Frank financial reform effort that followed. Mark's got a really unique insight, a view of both the markets and what's happening in Washington. And he's also got a book coming out this fall from his tenure at FHFA that will talk about how we did not have a mortgage crisis during the COVID pandemic, despite all of the disruptions in the market there. So we'll get into that later, but first I want to get your view on kind of what's going on in housing markets. A lot of news right now about a housing bubble, and I'm interested to get your take.
Yeah, and I'll add a wrinkle to this in that, I have a PhD in economics, and it's been interesting because I've spent most of my career not necessarily holding economist jobs, but policymaking jobs, and I think it does bring a lens. And certainly the way I view the housing market primarily is through that econ lens, particularly sort of an econ 101, but spent a lot of time studying housing markets within the industry before going into government. And so I think we're at a pivot point, where we certainly have continued to see extremely strong price appreciation, but I think we're getting to a point where that extremely large gap between demand and supply that developed because of COVID, where, obviously people didn't want to list their homes. They didn't want to have, who wants to have an open house in the middle of a pandemic? And so you record low supply in 2020 into 2021. You had seen, construction restrained for much of the Great Recession. And then COVID hit and everybody wanted to, leave the city and go out in the country. And that really obviously created an extremely large demand. As well as the relief checks and the record savings we were seeing in 2020 really drove. And that's why, for instance, in 2020 and 2021, you had record percentages of home buyers making all cash deals. It's just astounding. Right. So where I see we are now is there is still a gap between demand and supply, but it has narrowed considerably. Builders, certainly in the multifamily space, we were at decades highs in terms of construction for apartment buildings, multifamily space. But even the single family space, we're building as much as we did since before the crisis. That's not to set aside supply constraints, but we are seeing things like lumber and other material prices moderate. So we are seeing demand and supply catch up. And of course, the increase in interest rates has started to moderate demand, while there's some demographic headwinds and pluses rather, where the millennials are coming into their home buying years. You are starting to see the income growth slow. In fact, real wage growth is negative. All that savings that really built up during COVID has started to wind down. So again, this is the power of Econ 101, waning demand, increasing supply. You're going to see a moderation of prices, if not a decrease in some markets. So I would say over the next 12 months, probably about a third of markets will see real, after inflation declines in house prices. The average overall nationally is not quite there yet, but I do think we are absolutely at a turning point in the housing market.
Well, and so I think that's an important point. You just gave us very much a market-based perspective there. And I'm curious, you talked about the kind of the gap, the disconnect between supply and demand. I'm curious, you and I have talked before about the disconnect between the way that the markets view what's going on and the way that Washington views what's going on. What's your take from more of a policy-based perspective about what is or should be happening or not right now in light of the conditions that are out there?
So certainly one of the problems and one of the contributors to the price appreciation, certainly over the last 18 months, is Washington often sees economic weakness through a demand lens. I mean, most of our housing mortgage programs were created in the 30s where it was a view of a demand deficit. And of course, one of the big problems in the last 2-3 years has been supply constraints. So, rather than, opening the credit box, which the Biden administration has done, that increases demand. And so they're not responsible for all of the price run up in the last 18 months, but they're responsible for some of it because they're essentially pushing prices up. So if anything, at this point in the cycle, just as the Fed is normalizing and taking away a little bit of the punch bowl, we should be doing the same thing on the mortgage side. This is the time when you strengthen underwriting standards. And unfortunately, my view is the Biden administration has gone the other direction.
What specifically do you mean there?
So both at Fannie, Freddie, as well as FHA and the primary mortgage programs, you've seen an increase in like high debt-to-income lending.
Yep.
They've lowered FICO standards. They've lowered standards for down payments. And again, all of this opens up the credit box. And of course, their objective is how do we deal with issues of racial justice by getting more people into the mortgage market? And I would say absolutely wrong time to do it. This is about the top of the cycle. The typical FHA loan, it's a 97 LTV, but you can roll in closing costs. So you leave the table functionally underwater. And that's fine if you're in an environment where housing prices continue to go up. And it's also important to keep in mind that part of the price appreciation we've seen in the housing market is a reflection of inflation. So if the Fed is successful at bringing down inflation within its 2% target, you're going to see a corresponding decline in house prices simply because of that. And so I worry that we're getting borrowers into the market with extreme little equity, with very high debt burdens at the time when the economy may be weakening. Now, fortunately, we do continue to have a recovering job market. And I would say the canary in the coal mine really to watch here is going to be the job market. As long as the job market stays solid, then the housing market will probably be okay. But really, the frustrating thing for me as a former prudential regulator is you really should be planning for the bad times during the good times, right, and not simply waiting. It's like, it's not a crisis tomorrow, so we can put it off. So certainly a big problem in Washington. You could say this is true for a lot of things. It's, the CBO's recent quarterly, semi-annual forecast came out. The Social Security Trust Fund trustees' recent report. We're not really good in Washington at fixing long-term problems. If it's a problem that's more than 2 weeks away, nobody really seems to want to take the energy to care about it. So it's not that I'm predicting that the housing market or the mortgage market's going to fall off a cliff tomorrow. But what I am predicting is there will be a turn in the market at some point, probably within the next 24 months. And we really should be taking the actions today to soften that blow.
Well, so let's throw in yet one more complicating factor here. You and I have talked about this before too. How does the war in Ukraine, the dollar-denominated assets that Russia, that China are holding, factor all that in for us? We're playing 3D chess here.
Obviously the top-level most obvious effect is the inflationary effect, but there's also the effect on the agency MBS market. And it might not seem immediately, and maybe because I work in the mortgage finance space.
Well, and agency MBS for those listeners who might be.
Fannie and Freddie mortgage-backed securities.
Yep.
And so about a fifth of our Fannie, Freddie, and Ginnie mortgage-backed securities markets has been funded overseas. Mm-hmm. China tends to be the primary purchaser. Japan has been a big purchaser, but even Russia in the past. So for instance, during 2008 crisis, Russia actually went to China and said, let's dump our Fannie and Freddie securities to rile the U.S. housing market. Fortunately for us, China said, no, thank you. But the relevancy for today really is, the unprecedented and appropriate isolating of the Russian central bank and its ability to essentially sell off its dollar-denominated assets. You have to believe the Chinese are taking notes. And the relevancy for the mortgage market is going to be that I think you will see the Chinese appetite for Fannie Freddie securities to diminish in the near future. Because there really is this risk that, for instance, were there to be a conflict with Taiwan or otherwise, they would be counting on being able to use those assets and convert them into dollars. And now there's a high likelihood that they won't be able to. And, that may not be a big deal again. Their size in that market is small, but prices are set at the margin, so it does matter.
Right.
But it's also happening in the context where the Fed, at a minimum, is moving away from being a large purchaser of mortgage-backed securities. It's still too soon to say whether the Fed will be a seller, which they could, depending on where inflation's at. And I think there's also a question of, the Fed really in a big way, obviously both in 2008, but particularly in March 2020, stepped into the market when there was a lot of disruption in the agency market. And of course, that's something I'm going to talk about. I do talk about in my book, where that coordination between Fannie, Freddie, FHA, and the Fed and our tracking of the mortgage market, the relevancy going forward is if, for instance, we're 12, 18 months out and there's disruptions to the mortgage market, if inflation is still where it is today, I don't think you can bet on the Fed being as big of a purchaser and a stabilizer of the mortgage market as they've been in the past. Because I do think the political pressure –
They just wouldn't be able to.
Yeah, they wouldn't be able to, and their priorities have changed a little bit. Now, of course, if there are broader disruptions to the economy, which may well happen if there's a disruption in the mortgage market, but we've got a very different mortgage market today than we had in 2008. Obviously, post-Dodd-Frank reforms have reduced liquidity in the dealer supply for not just treasuries, but also Fannie and Freddie securities. And the Fed has really stepped into that role. You've seen a lot of players in the non-bank space, such as mortgage REITs, step into that role. And many of them have significant maturity mismatch. I mean, they'll fund long-term mortgage-backed securities in the overnight repo markets, and that's a very fragile funding source. And while the Treasury market has gotten attention from the Fed and others for standing repo facilities, we don't, and I'd be clear, I'm not advocating for a standing repo facility, overnight repurchase facility for agency securities, but you don't have that same sort of support. And so I do think we're at a point where, none of these things are certain to happen, but there's a high enough probability of disruption in these markets that we really need to pay attention and be concerned about them.
So you hit on political sensitivities, and that's always the kind of the underlying factor around here, of course. I'd like to push into that a little bit more explicitly. Let's talk about the way that things are looking right now. It's looking like you're going to flip the House, probably the Senate too. How does a change in power in Congress impact the housing markets going forward? What do you see? What do you see happening?
I think
there?
it will be helpful. So certainly the current assumption is that were the House to flip, Patrick McHenry would take over House Financial Services, and that Tim Scott would take over Senate banking if the Senate flips. I think they both are very smart on mortgage policy. I think Senator Scott's a good balance between the safety and soundness and access. So he's not someone who's going to be dismissive of the access to credit concerns, but I think he is someone who's going to look at this and say, are there concerns there? And of course, there's a lot of rumor running around whether Tim Scott's probably high on anybody's list in 2024 as a vice presidential ticket. So he's certainly someone who's going to look at what the party outlook is on Fannie and Freddie. He's certainly going to look at this on how does he establish a record against the administration. Now, the flip side is that, ranking member Sherrod Brown, knowing that Tim Scott is a national contender, is not going to want to do anything for him. So I think unfortunately, back in our days, there was at least some bipartisan. I like to remind people when we did the Housing Economic Recovery Act in 2008, I think we got 84 votes.
Yep.
In the Senate, it's really hard to see anything financial services mortgage related today in the Senate getting that kind of support. Even the Crapo bill a few years ago was relatively modest. Tester, Warner, and a few. So I think it's a very difficult environment. I do think that both McHenry and Scott will engage in a considerable amount of oversight. I think they see this turn in the mortgage market. I certainly think they want to be on the record as having, warned against it and made sure that, if things do go badly, that the Biden administration bears the responsibility, publicly for it.
Right.
I'm not terribly optimistic that you'll see, legislative push, but things could change. A lot of speculation over whether if Yellen leaves at some point, who would be Treasury Secretary. So in the off chance that someone like Gensler went over it to Treasury, I may have some disagreements here and there with Gensler, but he actually understands the mortgage-backed securities market and he understands the problems there. And you're not really going to get, like, for instance, one of the reasons the whole Corker-Warner effort to reform Fannie and Freddie years ago went nowhere was because the Obama administration was extremely lukewarm and put no push behind it. And as someone who tried to do mortgage reform during the Bush administration, I mean, they waxed and waned on how much they wanted to get done. But you certainly are not going to have a reform like this happen if there's not a commitment from the administration. And right now, I believe the Biden administration's emphasis is more on access to credit than it is on safety and soundness.
Yep.
So maybe that'll shift as the mortgage market gets weaker. And certainly I've been a little critic of this in some regard, and the what I would say is a bipartisan obsession with crypto and stablecoins and these sorts of things, which, again, deserve interest. But it's hard for me to look at the impact and the size.
Levels of magnitude.
Yeah, it's hard for me to see that. I mean, Fannie and Freddie are about $7 trillion market. Their debt is withheld throughout the system. There are lots of retail investors who have, so-called govy money market mutual funds that are actually stuffed with, the debt from Fannie, Freddie, and Federal Home Loan Banks. So there's risk for the retail investor. Obviously, the biggest risk is, we all live in houses, and even bigger risk, there is as the economist and me would say, a marginal propensity to consume out of housing wealth. And so if housing wealth declines, and it certainly should be said as an aside, a lot of the strength in consumer spending, not all, but a portion of it, has been driven by the increases in housing wealth in the last couple of years. People feel very housing rich, at least some segment of the population. If that were to turn, you would see a significant decline in consumer spending. Now, of course, there's a lively debate over, since housing really is the primary transmission mechanism for monetary policy, is the Fed trying to engineer a soft landing in the housing market?
Well, so I want to pick up on that. You alluded to, I mentioned it earlier, Mark and I used to work on the Senate Banking Committee. This was back in the run-up to the financial crisis, the Dodd-Frank financial reform effort that followed that. And I'd like to, you have a unique perspective and ability to kind of draw out the similarities and differences between what was happening then, which at its core was a mortgage crisis, and what is happening now with the housing markets being so critical. What are certainly a vastly different interest rate environment.
Absolutely.
But how does that factor in, and what are the other big similarities and differences? And I guess more importantly, what implications can we draw from this?
Great question. And there are a lot of similarities and a lot of differences. And maybe the biggest difference is when you start from an extremely low interest rate environment, and again, the interest rate environment in the mid-2000s was low, but it was nothing like today.
Right.
And, the fact that in the last year you've seen mortgage rates go up over 200 basis points is pretty dramatic. I mean, almost a doubling of mortgage rates in a year's time. And so it does have a really big impact in a way when you're starting from lower rates. And so the rate environment to me is much more fragile than it was in 2008, and I think will have a much bigger impact on housing demand than then. The biggest difference, certainly from a financial stability perspective, is essentially 90% of the mortgage markets, when you look at Fannie, Freddie, and FHA, certainly FHA, Ginnies are, full faith and credit guaranteed. Subprime, in my view, did not go away. It went into FHA, and that's about a $1.3 trillion footprint, but it is directly backed by the taxpayer. So there is no question about.
Say a little bit more what you mean about it not going away, but going into FHA for our folks that aren't as well versed in the housing markets as you are.
So you often hear this kind of argument of, well, credit quality is so much better, and there's no more subprime. That's not true. Credit quality on average is better, but it's also important to keep in mind the average loan in the Great Recession paid too. This is really never about the average or the median credit quality. It's about the tail risk. And so the subprime mortgage market going in 2008 was a little bit more than $1 trillion, and that's about the size of FHA. Certainly the product features are different in some regards, but and there's a lot of debate. In the industry, mortgage industry, subprime generally refers to the credit quality of the borrower, measured by FICO or Vantage or whatever you want to look at. And often the popular dialogue focuses on, the adjustable arms and all these other, weird products, pay option arms, all these things. And so certainly most of those bizarre products have gone away. But you've got still pretty poor credit quality of borrowers in FHA. You've got very high loan to values, very high debt to incomes, and all of those things. Certainly the debt to income and LTV, even in the Fannie and Freddie book, are worse than they were in 2008. The primary focus of discussion often focuses on FICO. Now, I'm of the belief that certainly during COVID, we've probably seen about a 20-point FICO inflation because of the non-reporting and some actions that were taken in the financial crisis. So to me, I think compared to a 2005 book of business, FICOs are inflated probably about 30 points. So they're not actually as great as people claim they are. But again, a lot of that subprime, the borrowers who would have gotten a subprime loan in 2006 are now an FHA loan. Now, the plus, of course, is that you're not going to have the market hiccups of thinking about whether the underlying securities are going to get paid or not. A Ginnie may, full faith and credit backed by the federal government is not the same thing as some New Century MBS pool that somebody put together and you don't know how many times it's been tranched or sliced or whether it's going to pay. So you don't have those problems. But, you do have a lot of the servicing, those entities who make sure that things get paid and make sure, go by and check on the lawn gets mowed if the loan goes into foreclosure. A lot of those moved from banks to non-banks, so non-depositories. And, you still are going to be looking at relatively high delinquencies in the Ginnie Mae space if there's trouble. So that's the concern here. And, of course, lastly, there's just so much more leverage. Fannie and Freddie, obviously going into 2008, they were leveraged 60 to 1, which is still too high for any large financial institution. Today, they're leveraged 100 to 1. And while the credit quality might be slightly better, the leverage is just so much higher. And the real difference to me as a taxpayer is you at least had some private capital in the system last time. You have almost none now. A sliver. And so I would certainly think a large bailout of the system would provoke a lot of political problems. You could, in a stressed down housing market, put $100 billion into FHA and put another $200 billion into Fannie and Freddie. And, I would consider having to write a $300 billion check. Maybe today when we talk trillions regularly is small money, but I think there'd be a lot of public frustration with why they weren't fixed. You're in an environment where, the White House Chief of Staff used to lobby for Fannie Mae. These stories write themselves how the bailouts and connected. And so the same sort of distrust that the public has had for our institutions that came out of the financial crisis, I kind of feel like we're doubling down on gambling for that.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All things considered, with the state of the markets right now, with the tools that the Fed and Treasury do or don't have, back then compared to now, are we in a more precarious situation or less?
I think we're in a more precarious situation politically. I think we're in a more precarious because, again, I think the public backlash to we were told these things were fixed. And I think we are precarious from a macroeconomic standpoint because, again, a decline in housing wealth will show up in consumption, employment, so there's a big knockoff effect. I think the difference, and it depends on your audience. From a Wall Street perspective, you may have more comfort because certainly the Fed, not only 2008 but post Dodd-Frank, but 2020 has shown a willingness to probably go in heavy with in terms of market disruption. So I would say there's a much greater likelihood of some stability being provided by regulators. But I think at the end of the day, if you're a member of Congress, okay, maybe you won't have to make an uncomfortable TARP vote, but this is going to blow back in other ways. And I think at the end of the day, the public doesn't look at this and say, well, I'm less mad because the Fed engineered this bailout rather than Congress.
Right.
So I do think we're kind of playing with fire politically in terms of public trust and, again, the macroeconomic impact. But I think the potential for a financial crisis is probably less, although, again, I would emphasize our mortgage market looks so different than it did last time. We've made this huge shift from being supported by depositories, which have strong balance sheets, and a reputation at risk, to a big change. And I'm not dismissing the positive role that non-banks have played in the mortgage market. They've played an important role, but it's untested. So the point here is that so much of the infrastructure and plumbing of our mortgage market has not been tested in a stressed environment. And so I simply worry about the uncertainties there and think we need to start thinking about them. And of course, let me lastly say, I would be delighted to be wrong in all of that.
Right. Well, so that's a good transition point. During the COVID crisis, we did not have a mortgage crisis. You were the director of the Federal Housing Finance Agency during those couple of years. And I know that you've got a new book coming out in the fall. We will certainly have you back on to talk about it more. But before we leave, I want to be sure and get a kind of let you talk about what the high points, what the main points of the book will be and what readers can expect.
The real focus, so part of it is what we did differently in terms of forbearance and why I think it worked relative to the Great Recession type programs like HAMP and HARP. There certainly is a chapter about servicer liquidity and why there was not a breakdown in that, but also why we should not be blasé about the fact that there was not a breakdown, despite some predictions for that. So it really is lessons from the crisis, why things were done differently this time, why some of those lessons may be applicable in the future, and why some things do need to actually be different the next time around. Because again, the next crisis, let's hope, is not a pandemic, but there will certainly be another crisis at some point. So how do we make sure our mortgage finance system is built to withstand that? And of course, there are just lessons about, I entered an agency that had a lot of problems in a number of ways, low morale, question about the future of the agency. So I hope some lessons about, how do you turn around a troubled agency? How do you give that stability? So hopefully there's a lot of lessons there and a lot of insider, conversations. If people are curious what it's like to hang out with Steve Mnuchin in the cash room during a pandemic, then you'll get some insights with that as well. And so some of it is some perspectives on some of the players, which I thought was important because I don't see Mnuchin or Powell or really Mick Williams or anybody else during the crisis writing an insider. And I thought the Paulson, Bernanke, Geithner books. I might have had some disagreements with elements here and there, but that was an important part of setting the history of that crisis.
The record, yep.
Yeah, and so I think it's important that somebody on the inside leave a record. And so I'm trying to fill that, and I hope people are interested in reading it.
Well, I'm going to go ahead and put you on the spot to commit to coming back to talking about it once it comes out in the fall.
I would be delighted to.
Awesome. Well, look, that's about all the time we have for today. Thanks for tuning in to another episode of HPS Insights. A huge thank you to our guest, Mark Calabria, today. You can find out more about Hamilton Place Strategies' work in our podcast at www.hamiltonplacestrategies.com or by following us on Twitter at HPS Insight. I'm your host, Jonathan Graffeo, and as always, thanks for listening to HPS Insights.
Thank you for listening to the HPS Insights podcast, produced by Hamilton Place Strategies. For the latest updates, follow us on Twitter at HPS Insights and follow us on the web at hamiltonplacestrategies.com.